Welcome back to Good Revenue. We're here today with Jennifer Krusius. She is with ABS Capital and has also been an operator and a founder. Welcome, Jennifer. We're so happy to have you.
Thanks for having me. Super fun afternoon for me.
It's a pleasure. I'm looking forward to it. We'll jump right in. You have an awesome background. You've done a ton of work across investments and as an operator, and it's across a range of sectors from digital infrastructure to enterprise tech to human capital management. I love that you have such a diverse background. And you've also been a co-founder. I wondered if we could start with your experience at Vivacity.
Vivacity, just high level, develops fiber and wireless infrastructure and co-founded the company with another person at Columbia Capital. They were the seed money, and the company was really born out of a smart cities thesis. So our first project was a smart city project in Virginia. It was interesting because as the first project, we certainly learned a lot and did a pretty fast pivot after that. Basically, the project went really well. It was really interesting, but it was a lot of customized work. And as we were going through it between the permitting and approval process and the customization, we're like, this business model is not going to scale. Like, great idea, but to grow a really big company, it's just not going to work this way. We had made contact with a variety of customers and listened to what they were interested in, pulling us in a little bit of a different direction. And I think that piece of finding a company is like really the scary piece, at least it was for me, which is you've gone out of your way to convince people that a certain path is the future and you just need to get the customers along board with you, and you've done all this market sounding. And then in reality, it doesn't always work out that way. And we also bought two other companies along the way with this company and integrated them together to provide more services, which also changed a little bit of the selling dynamic. And it's been, I think, a 6-year since we founded the company. It's grown quite large now. The other difficult part in there was trying to get the products standardized. So all of the work is somewhat custom, but trying to get big logs in place of, okay, this is repeatable work and these are repeatable skills and projects, and how you staff that to get the efficiency of the back end. But I think one of the big learnings for me in terms of applying it back on the investing side is how difficult it is to change with people. So you've brought all these people on, convinced them to work at a startup, and then the product changes or the market changes or your thesis changes or the business model changes. Some of those people come on the train and off the train at different times because they're true believers. And when things change, maybe they're less true believers. That can feel really personal, both to you and to them, which is a dynamic that's less pronounced in later stage investing. But it was a real unlock for me to understand what people are going through at that phase.
There's so much in that. I love it. There were two things in what you said. One was the question of market sounding, customer insights, understanding the customer and using that insight to firm up or adjust your theory of the case and strategy. And then also that question of when to pivot, should you pivot, or when to just push through was part of the success for Vivacity, or some of the challenges figuring out when those pivots made the most sense, or was it more around the customer insights really drove your strategy and your path forward?
I always encourage companies, if they start to feel like a spark of things, to pivot. Human nature, especially with founders, is such that they get really driven and committed to a particular idea. And that's what makes people successful. So I
Right.
totally understand that piece of it, but being open to listening to customer feedback and really being able to hear that in an objective way is very difficult to do, especially like if this is your baby and your idea and you spend all this time convincing other people that your idea makes sense and it's the right move. It's hard to receive and hear that feedback. And so I think as soon as you get an inkling, you should follow that intuition, which is to say, really try to lean into that. I think the people that pivot, especially at the early stage, the fastest with the least amount of friction or resistance tend to be the most successful. And there's very few cases I've seen over time, and it really is only in super high growth companies where the quick pivot becomes a distraction. Usually it's a highly uncommon problem to have that, and much more common to say, I really do need to change or edit something here.
Yeah, no, I think it's so interesting. One of the buzzwords, at least out in the Valley right now, is conviction. I sometimes wonder if anyone's doing longitudinal studies of verbiage because you hear peak terms at different points in time. And I always think it's interesting. And conviction is one of the ones that I hear a lot. The one that I don't hear as much about is, are we traveling in the right direction? Maybe there's not a pithy word for that. But conviction, I meet a lot of people who have conviction. It's not always clear if they're traveling in a direction that makes sense or what the evidence
Like
is for the
progress
direction.
at the conviction.
Correct. It's a little bit around the advice sometimes is just have goals, just have OKRs, just execute. And I am all for execution. I'm a doer. I know you're like that too. But to me, it really matters what direction we're pointing in, right? We could execute super hard in the wrong way and just end up in a ditch. There's a segue there, which is we have moved from the era of growth at all costs, cheap financing to an era in which a lot of founders and obviously investors are trying to help companies balance growth with EBITDA and revenue quality. What has that experience been for you as an investor in terms of what you're advising startups to do now versus maybe what you might have done a few years ago?
There's definitely been the mentality, and it goes back even more than probably 2 years, like you mentioned, but this mentality of grow, get market share, and you can fix things later. Fix later tends to be by raising prices over time or getting efficiencies of scale. But the reality of life, which we see in many other patterns outside of business, is that once you get used to a level of spend in a business or a certain way of life, it's very hard to actually see the efficiencies of scale because usually that money ends up getting spent in that area or other areas. People don't like to peel back and suddenly become efficient when they weren't from the start. That's a very difficult thing to digest inside a business in your personal life. Nobody likes that feeling. I think that idea in itself was flawed, which is growing market share and growing quickly and then fixing it later. It's like kicking the can down the road. And I think we see more times than not that doesn't work. And I do think to the point of how advice has changed over time, there are some cases where if you're being paid on a revenue multiple, growth makes more sense than, and I think that was the argument for folks is, oh, we'll get to profitability eventually. I think the advice change for me as I've been thinking about the different dynamics and what founders are hearing from other investors, because you're never like the only person the founder's talking to. So regardless of whether it's your advice or not, that there's other influences on folks you're speaking with. I think for us, what you really need to do is work on gross margins now and think about, is the fundamental business a really sound business? Because you can work on growing into your OpEx later, but if your top line and your COGS don't line up to a gross margin that is profitable and gives you enough cushion, it's very difficult to get there later. So I think we've shifted from unpacking someone who says, hey, I really want to grow and get market share, to say, okay, that makes sense as long as one, there's a budgeted envelope for what that growth is that we talk about at a board level. And then two, that the underlying economics make sense such that growth is coming with more cash flow generation to ultimately pay for the investment in the business.
Yeah, I totally agree with you. I'm nodding aggressively over here because I think you're right. That idea of kicking the can down the road does not pan out. A lot of folks have fallen into the trap of high valuations that cause all sorts of issues when the good times end. And then digging out of that hole is not a task that most people enjoy or find successful, right? It's just very challenging.
The repercussions there too have gotten more dramatic, right? Where you might have kicked the can down the road and raised more equity and would have diluted you a little bit. Now the consequences are dramatic. I think as we think about the rest of the year panning out, we've got a potentially more rocky road ahead in terms of its election season. We've got geopolitical risk. We've got a potential economic downturn. Some of those weren't present a couple of years ago or a year. Having more of a cushion, I think, is even more important now, which is part of the conversation with folks about getting to profitability, or at least having a little bit more control of your destiny going into a rocky road.
What are you seeing in terms of where companies might be, or maybe the flip side of that is, are there suggestions around what you think companies could do differently to meet the moment?
Yes, the reality is a lot of companies built these cost structures in a different landscape. And now the landscape has changed. Cost cutting is not a fun exercise for anyone. Just so you know, investors don't enjoy it either. But the reality of pivoting on the market fit side, the faster folks pivot, the more optionality they have, the more opportunity they have to shape a business in this environment. We see folks slow to change. And part of that is maybe an optimism, because a lot of times the CEOs that are great salespeople, like they're optimists, right? And they think maybe the market's going to come back around. I just got to hold out through this period until the market comes around. And I think the better advice, which is hard, and I appreciate it's hard to enact and do, but it's to be building the company in the market you're in. And so when the market's moving, you need to move because you'll be more successful and nimble. And then when that market changes back to your favor, instead of saying, oh, I'm so glad the market is back, now you say, actually, I've built so much more than all my competitors in that meantime. And now I have a much bigger advantage, which is really important for a company at this stage.
Yeah. What do you think founders can do to focus on business models and viability earlier in the life cycle of their company?
Failing fast is a big piece of that, which is to say, you have to think about listening to the customer, fulfilling what the customer wants on the one hand, and what is the business model? So I think people on the one hand fall into the bucket of this temptation to have the perfect product versus a lot of tech spend, which probably isn't necessary. And then there's a variety of reasons why customers might not be buying. And we see that a lot. Sometimes the symptom of that is, I just need to hire a salesperson, or we need more resources so that we can get access to the right folks because this is a long sales process, or it's a long sales cycle. And really, the underlying issue is that there's not great product market fit, and there's a need to get to the bottom of that versus thinking that time or money will solve that solution, because it usually doesn't. And then other times it's adjusting the business model. It's so like when I worked at Uber and launched some markets on the East Coast, at the time, Travis's vision for Uber was, we want everyone to have Uber at any time and at a reasonable price and at a reasonable time. When you're launching a market and there's not that many supply available, like that, it was pretty patchy in the beginning. The answer there was surge pricing, which is to say, hey, actually, we need to change our business model. Instead of thinking about it as, hey, we want a reasonable cost of transportation, who are we to say what's reasonable? I have to wait 15 minutes, which was undesirable, but maybe it isn't desirable. As a customer, if I can't get another ride, 15 minutes, I'd rather take that than no ride. Or I'd rather pay 20% more because something's available. I think it's trying to play with both the product and the business model until you really feel the pull. Because I think when you feel the pull, it's there. It's when you can't quite find it that you need to keep adjusting the levers until all of a sudden it goes.
That is such a great example. And I feel like it articulates something I'm really passionate about, which is I think it's a mistake to tell people that it's product market fit. I think it's product market pricing fit. I don't think we tell companies, founders, this maybe early enough. You're constantly moving between that if it is a triad. And I think the other thing that really resonates for me is it evolves over time. At launch in a market that hadn't experienced the product, that's a different stage than when you're saturated in New York after 15 years or whatever, right?
And I think if you got to think about all the different customer segments there too,
No,
right?
totally.
You may think that the product is transportation services in an urban area. I ran a lot of cities in Pennsylvania, some that were very urban, some that were very rural, some that had more drivers, some that had more riders. And the value proposition was different to different folks. Thinking about whether you want to stay focused and offer your product to a very specific customer set, which involves the discipline of saying no to other folks. But you know that when you find that customer, it really flies through the channel and people get really excited and it's the perfect fit and you don't have a lot of churn. And other times you want to say, I'm serving different use cases for different needs and I have to stay flexible. I think we see companies do that more, especially early when you're just trying to get revenue from a variety of different sources. But then it becomes difficult to separate some of the data by use cases and understand the right pricing and value proposition for this particular segment versus something else. And maybe you're trying to put one product to all of those folks when there's a little bit of differentiation needed.
Oh my God, bless you for bringing up segments because I look at my customer segments all the time. Another topic that I don't feel like we discuss it enough, just what a segment is and how it's different from just a general ICP or persona. So I could not agree more. That's super important. Obviously, investors have a lot of influence in the financial plans of most companies, particularly earlier on. And as an investor, you want the bet to pay off. Obviously, the founder also would like the company to be successful. Has your thinking evolved in your career as an investor or just across the last few years when it comes to scaling? Because one of the topics that's coming up a lot is that acquisition costs have become excessively high. I'm seeing a lot of data, and I bet you are too, that it's 48, 60-month payback period, which is not just unsustainable. If you have high churn or poor NR, there's no business there, right? Or it's a very difficult business. So I guess, could investors be doing more? What is your take on that? I know there's a lot in that question.
Yeah,
Just a small question for you, Jennifer.
I think for me, the nature of the question is a broader reflection of where we are in the cycle, which is to say, there was a point in time where if you're raising, it depends on who you are at the table, right? But if you're an earlier investor, or you're a founder of an earlier company where you think you're going to do a variety of raises over time, what people are valuing is revenue. And so paying more and spending more to get more revenue, and so those ratios don't look as great, that made sense when you're being paid on revenue.
Yeah.
When you change how folks are viewing the market a little bit more to profitability, now that money is not coming down to the bottom line for all the reasons you mentioned, right? It may be that you paid too much to acquire them and it wasn't efficient use of dollars. It may be that they churn off and now you've got to replace them more. So you've created this cycle that's expensive to maintain. And now you also have less dollars to work with coming down from your gross margin. Honestly, it's probably a disservice to companies that investors have been advising to go for some of those things. People get used to it. And then getting discipline back and saying no to folks. We saw a couple of years ago a lot of inefficient spend in terms of advertising dollars and market efficiencies in that area. It was like, this is wild. There's a group of investors, probably 50%, saying, no, go do it. You're getting paid on a revenue multiple. Go get all the revenue. Like, we'll adjust this later. It doesn't matter now. You got to know where the goalpost is to work towards that. That's where I think it's a bit of a disservice. If you're a founder trying to build a long-term sustainable business, you're paying the price for that decision. And you've built this cost structure that you can't maintain. So you almost have to go back to the basics and back to the drawing board with what is my go-to-market sales motion? How does that make sense? And that's difficult to do the later stage you get in the company. These things feel really difficult at the beginning, but they are much easier at the beginning because there's 5 people on the sales team, not a huge sales team. I think that's the other error we see a lot is if I just add more salespeople, a bigger sales team, more sales dollars, then this company's really going to grow. We're going to ratchet up that growth rate. The reality is that for almost all companies, that doesn't work. That's a cover up for some other inefficiency issue, which is maybe it's the wrong fit, maybe it's a long sales cycle, maybe the pricing's not right. And it's more important to get those things right or test a couple different things so that you know with conviction, if we put more money behind X strategy, that is an efficient channel. But it's hard to have the discipline to do that.
You're so right. And I think it's also that it used to work. It used to be enough that you would just hire 10 salespeople and make up a number and some assumptions, and that would all. And I think one of the things we don't talk often enough about is just, I think the modern buyer journey has changed a lot too. There's a ton of evidence out there, particularly in enterprise, that it's far more self-serve and there's a lot more agency on the part of buyers and complexity. There's this data from G2 from about 2 years ago that said there's something like 22 people now in a buying committee. And I've heard anecdotally as much as 80, which blows my mind. But it makes sense if you're selling into an IBM or even a Google or something, right? That's an incredibly large, complicated organization. And when we advise startups to hire, we're not taking into account what that road looks like for each one of those sellers. I know you see this too. You're also reminding me of something that came up when we first talked. I wonder if we could get you to share a little bit with the audience. You made a great point I hadn't thought of, which was founders receiving a lot of different advice depending on the type of investor they're talking to. It can be really challenging for founders to navigate advice and who it's coming from and why those stakeholders or potential investors might be offering that perspective. So I'm hoping you could talk a little bit about that, because I think I thought that was very insightful.
Yeah, it's interesting. We're a growth equity fund and we're late stage venture, early stage growth. We call it emerging growth. It's companies in their teenage years. A lot of times when we speak to companies, what we're hearing from founders, and you can tell when, especially when like folks are looking for funding, they're talking to different people. Sometimes they mix you up with other people. They'll be like, I just pulled this analysis for someone else, and they'll share it. Like that is so not what we talked about. But I think what we see is that we compete with both venture firms, especially when the market has moved and things got more expensive. As a result, we went closer to venture, went upstream a little bit. We've got overlaps between different types of investors. If you think about what is the really down the fairway investment for a different type of investor, they're optimizing for different things. They're looking for different things. They're trying to shape different things and they're optimizing for different things. If you're at a VC fund, you've got to make a very quick decision because there's not a lot of data and it's very competitive and you don't really know. A lot of it is making a bet. And the way you're rewarded is like one of those folks hits the jackpot, one of the companies, right? And so everybody's trying to be helpful and move the companies along, but you're not going to really get paid well on the venture side unless the company goes big. And so either from the founder's perspective, you're hitting those metrics for the investor and they're really excited about you, or you're like the forgotten child and that sure, they're available, they're helpful, but you're not going to move the needle for them. And you've moved down in the priority list.
Right.
In the growth stage, we are hoping that when folks enter our zone, they've already hit product market fit. They have things moving, and what we're doing is adding money and investment behind specific things that we think really drive the needle. When it goes well, those work really well. And when it doesn't go well, it's usually because they didn't quite have product market fit or the market's changed. And so now we've got to navigate some new territory. Everybody loves a company to be super successful. The expectation is different, which is, hey, we care much more about getting to economic viability. We want you to grow modestly. And you're now in a different stage optimizing for different things. If you're a founder, it can be confusing if you're talking to a couple different types of investors. And then later stage than us, they're interested in leverage and adding some financial engineering component to it, which brings a different sort of pressure, but a different type of return profile. And so if you're a founder, it's hard unless you're sophisticated in the investing side, understand who you're talking to, what they're trying to do, what they're trying to optimize for. You want to pair up with folks that you feel like you're on the same team, driving towards the same goals. Everyone's selling each other in this phase, right? It's helpful to talk to a lot of folks on both sides, get a lot of different data points to say, what are these people like to work with? What are we really trying to get at when we're not having our just give me a term sheet as soon as possible talk?
At ABS, what are you looking for when you're looking at the founding team, leadership team, et cetera?
Yeah, it's interesting. I used to be really drawn to the storytelling CEO, the person who was really charismatic, optimistic, could sell anything to anyone. I think those CEOs do really well in growing markets, right? Because they are more convincing than the next person. And there's something about the excitement, both in terms of attracting talent and attracting customers that people just really want to sign up for. I saw that even when I worked at Uber, like we were very small and I would go in to talk to the Pittsburgh Steelers, which is like the premier brand in that market. I was talking to them and they were so excited to work with us because we were drawing a lot of attention and customers were delighted. There is this effect that can be really effective for CEOs that nail that. I'm trying to unbundle whether it's this market or just the evolution of my career. I prefer looking for CEOs who are in touch with the details because, like I mentioned, at the growth stage, you really want to understand the levers that move the business, what they do, how much they move the business, what problems exist, and where to plug in solutions to those problems. But it's very surgical and very specific and custom to each company that you work with. It is really, for me, easier to work with folks who clear on what those areas needs are, whether we can be helpful or not. Sometimes I'm like, we can't help you with that. This is not going to be the right fit, which is better not upfront, even though maybe that's not the most exciting answer. I like working with folks that are really down in the details. And those tend to not be the big storytelling, outward facing, market excitement skill sets. It's been a better match in terms of our working style and the work we want to do over the next couple of years.
I would imagine the odds of them being able to deliver on the vision as well.
It'd be interesting to go through our portfolio and see if we categorize folks what the performance was. I think it's easier to work with folks that are really into the details because you can get there a lot faster. But a little bit of that is my personality. And the charismatic CEOs, they're the ones that are selling customers faster, that are attracting better talent to their companies. Not always, but so I think there's a way to win in that boat too. It's just, for me, can be a more difficult personality to work with.
That's a great segue to one of the other questions I was curious about, which is across the portfolio, what are some of the investments that you're most proud of or that you're excited about? I realize investors love all the children, so we're not asking you to choose your favorite. What's interesting and why?
Yeah, one of the ones we did recently is a company called CareLoop, and they're focused on caregiving, selling as a benefit to employers. And I'm excited for them for a couple of reasons. One is we do a lot of thesis-driven investing, and so there is a lot of big macro trends that play to this company's favor. The population's aging, we have declining birth rates, we've got more households with two parents in the workforce. There's a labor shortage, structural labor shortage for the next 50 years. Employers need to make the most of their employees, and efficiency is important, and retention is more important than ever. And folks are struggling with taking care of maybe parents, or dealing with maybe not even taking care of them, but dealing with the healthcare system and navigating, and also raising children and having that on their plate as well, and then working full time. And so it feels a super important and impactful solution that's lined up against some really great macro trends. The other reason I really like them is they had done a lot of this gross margin efficiency work over the past year before we invested. They have a bit more to do, but I love a company who can look at themselves honestly and say, hey, we've got to fix this. And they're not so dug in on business model or pricing or delivery model that they can't change. And so I just like folks. It's refreshing to work with folks who are like, hey, this isn't working. Let's fix it. Let's keep trying until it's fixed. Whereas sometimes I think people don't have the courage to say that. They view it as maybe a shortcoming of themselves or their teams. And that's not always the case. It's, hey, if it's not working, let's just get on it and move on, right? And the company's all the better for it. So I love that they have the humility to do that and to make it happen. Another one that I like that I'm also really excited about is a company called Transfer VR. And they do trade training, getting folks into these really high-paying careers that are in high-demand fields, but don't require a college degree.
It's a huge opportunity.
I was just at a company event where one of the examples was elevator operators or elevator repair people in New York City are getting paid $189,000 a year. And if you're coming out of high school, the payoff for a college degree has gone down over time. It's not the right fit for everyone. So getting trained and having access to high paying and very stable career, I think is a really interesting, compelling opportunity. And they do that through virtual reality training. The education efficacy is much higher than a lot of classroom or hands-on training. It solves a lot of business problems. I think it's a really great, innovative solution in that space. And they do a really good job of connecting the dots for their customers and their end users. They call it a classroom to career pathway, which is drawing people from the classroom, getting them trained right into jobs. It's like a very on the ground tactical thing for folks. And I think it's just really cool to see folks connect those dots together.
That sounds like a great opportunity. I know there's an opportunity there. So I know that you are really passionate about investment and the opportunity to diversify who's at the table, particularly when it comes to women and people of color, whether it's venture or private equity. Will you tell us a little bit more about that?
Yeah, obviously I'm a woman, and I think it's been interesting to see as my career progressed that there aren't as many women in venture. because I don't think of it as a type of career that isn't well suited for all kinds of different skill sets. And you don't see a lot of people of color in the industry either. And I think there's an opportunity for really anyone who is math and analytics type of person who also enjoys people. There's a lot of different skill sets that get sewn together for a successful career in the space. Representation is really important for me. It's sometimes awkward, particularly at conferences. I went to a conference last year where there was literally 600 men and 10 women in the room. It's wow. But it's a little bit of an energy drain. I think it takes a lot of extra energy to navigate those situations, try to feel normal and make connections with folks. I try to go out of my way anytime I see someone who's not like me, or when I'm in a room of all women, to go speak to the man in the room and try to make them feel included. I certainly do that, of course, with other women in meetings. And I think in a weird way, it can be a little of an advantage because there's less women. I'm in Washington, D.C., and there's a smaller group of women investors, for example. And now I know almost all of them. And I would never know almost all the investors in Washington, D.C. You can use that to your advantage to figure out, how do I have a really tight network, and use that network to bring a different edge and a different advantage, a different exposure. So something that I think about is my network is different for a variety of reasons, but thinking about, how do I say, this is something great to contribute that is truly differentiated than other folks that work here, and bringing those into fold and thinking about, how do I spin this to an advantage for me and something that can be helpful for other people as well.
I appreciate that perspective. Is there anything else that you might offer as advice for folks who want to break in? Maybe it breaks down a little bit too with early career folks versus someone who's been an operator seeking to be an investor.
One thing I see quite commonly is women feel like they can't apply unless they have 90 or 95% of the job criteria,
Right.
or versus men who feel more comfortable saying some of these and I'll figure the rest. I read something that said 45% of men think they could successfully land a commercial aircraft if they had to. I feel like that just says it all, but I don't think 45% of us feel like, I'm going to take a hand at that. Thinking about how you get over that initial scare factor of, I'm not an expert in this, to just participate and force yourself to participate and get comfortable participating when you only know half the answer, and having confidence that you can figure the rest out on the fly, which is what I think, for better or for worse, men tend to be more comfortable doing. But it's maybe recognizing some of those differences and stretch and push in those areas make a difference. And then I think it is a lot of just being comfortable speaking up instead of passively watching and waiting for the one opportunity where you're the expert in the room. You got to participate at the table, and you can work on raising the quality over time. But I think folks, especially women, tend to err on high quality, lower volume. And that's interpreted by others as just less participation and less availability at the table, and then therefore less work allocation and less important projects. It has an impact.
Yeah. Self-fulfilling prophecy, maybe in some ways.
Yeah.
Jennifer, this has been such a great conversation. Thank you for joining us. I have one last question. You've had a really awesome set of experiences, and I love that you've been both an operator and an investor. What do you think high performance companies do differently from average performers?
I think probably put that in maybe 3 buckets. One we talked about is listening to and responding to customer pull. I think about this as employees at every level of the company, out there talking to customers, understanding what they want, what they need, what they are dissatisfied with. I think that sets folks apart. I think 2 is liking to win, which is like a really maybe less trusted response, honestly, but
No, I love it. That's great.
about building a culture about winning, getting people excited to accelerate the business and turn the wheel faster. It's fun to work at places like that. And I think you get an advantage in energy translates to business results. So I look for that in companies. The transfer is a really great example of the VR company mentioned. And then the third is where I see really successful companies, they have really good data. It's a central source of truth for the organization. It lets people at all levels measure their progress over time and make decisions without having to have a management meeting or talk to senior managers, which can slow things down, letting folks make better, faster decisions consistent with company goals.
I love it. That is such a great response. Thank you so much again for joining us. We really enjoyed having. Good to see you too.
Thanks for listening to Good Revenue. If you liked what you heard, please subscribe to the show, give us a rating, or leave us a review. It helps other listeners find us, and we appreciate your support. You can also catch full videos and highlights on our YouTube channel.